speak about the ICI strategy for the weekly time frame. Now the rules are basically exactly the same. You are anyway waiting for an impulse to the downside on the weekly time frame instead of the daily time frame. Then you're waiting for a retracement at least to the 382, and then you will be looking to take your entry, your valid entry on the 4 hours. So exactly the same rules. Now here I have identified some of the scenarios. You have an impulse to the downside that creates a low, then it's lower than this low. You have your retracement, you will be looking for an entry on the 4 hours. You have an impulse to the downside that creates a low, then it's lower than the previous low. You have a retracement to at least the 382, and you will be looking for a trade to the downside. You have an impulse that creates an equal high, so you have the possibility to create a head and shoulders. You have a retracement to at least the 382, so you're looking to find an entry in the 4 hours. You have an impulse to the upside, the market creates a high that is higher than this high here, the market makes a retracement at least to the 382, and you're expecting an impulse to the upside. Same situation here. You have an impulse to the downside, the market makes a retracement to at least the 382, and you're looking for an entry to the downside. And again here, the market makes an impulse to the downside, the market makes a retracement. You are looking for an entry on the 4-hour time frame for a push to the downside. So again, the situation is exactly the same as in the case for the ICI strategy for only the daily time frame. And in this case, we are applying it on the weekly time frame. So it's exactly the same as in the case of a daily time frame, but we're applying it on the daily time frame, on the weekly time frame. Now, what you will notice is that when you use the reply tool and we go and see what's going on the 4-hour time frame, you will see that you will get much bigger moves. The moves in the market will be much bigger, a lot bigger. Look how many pips we have on these moves. Because basically the take profit remains exactly the same. Now what I mean by the take profit remains exactly the same, if we go on the weekly time frame, what you realize is that if we take our Fibonacci from this high to this low, that will be our take profit, the minus 27 of the previous leg. So basically, if we want information on this push to the downside, we need to take our Fibonacci on the retracement leg. So from this high all the way to this low, and our take profit will be the first strong number above the minus 27. I will bring back all the levels for you guys. So our take profit will be the first strong number above the minus 27, which in this case is 99. So what will be the first strong number above? It will be 0.6720. This will be the first strong number above. So overall, let's basically use our reply tool. We already had the impulse to the downside. If we take our Fibonacci from the high to the low, you will see that we had at least our 382 retracement. Actually, we went all the way up to the 0.786. At this point, our job is to go on the 4-hour time frame and look for an entry. But before looking for an entry, you already know what our rules for entry are. We need to look for a shift in momentum to the downside. And as you can see, we already had it. The market has already cut below the 0, and the market is below the EMAs with distance between them, and the 10 EMA is below the 20 EMA. So perfect. Everything is pushing to the downside at the moment. What will be your next step? Now your next step will be obviously to look at what kind of structure you have, and you can immediately see that you have strong resistance around this area. You have a nice structure here. Now what you need to know is you need to look at what kind of numbers you get, and if you double click, you immediately realize that this is 80, and the slippage of 80 will be 95, as you already know. So this will be the strong area for you to look into. Now if you realize this is the real level of resistance, you can see that this is the level that is respected on a closing basis. But if you want to really stay safe about this, you can just take the entry exactly on 80 and just put your stop loss above the area, and your take profit, you already know where it is. Your take profit is at the first strong number above. the minus 27 of the previous weekly leg, exactly as in the same way as for the ICI strategy on the daily time frame. And what you realize is that the market first of all respects, then you have a little bit of a drawdown, then the market goes again in your favor, and this is the exact moment in which you go risk-free, because the market created an impulse, retracement impulse. Now you can go risk-free on this trade, so you have no risk involved. The market is melting. Let's see if the market creates a reaction to this area or if it breaks. So it seems like the market is actually rejecting the area, but overall we know that the minus 27 is supposed to hit. Okay, at this point, if we have any kind of rejection without hitting the target, we will just close the trade manually. Okay, we basically close the trade manually here, because it's clear that the target almost hit, and some brokers actually might have actually hit. If for example you go on net dining interbank fees, probably this level actually hit, but on this particular broker it just missed by a couple pips. But when the market is really near your target, we already spoke about this, and it starts rejecting, just close the trade. You have your 1 to 3.48. You should be more than happy to bank these profits. So let's go with the next example of the ICI strategy on the weekly time frame. So the next example, we will just take it here. As you can see, again, we have a huge amount of pips. Look how many pips we have on this move. We have a crazy amount of pips. That's why I say that the ICI strategy applied on the weekly time frame, when the weekly time frame gives you an ICI opportunity, you should definitely be looking at it, because you have some very big swings. Look how many pips. So anyway, let's use the reply tool. Let's go on the weekly time frame and let's see what's going on. The market already created a new low. We already identified this. The market created a low that is lower than this previous low. And also, if you take your Fibonacci from the high to the low, you quickly realize that the market has already retraced more than the 382. Perfect. We can now go on the 4-hour time frame and look for an entry. Now going on the 4-hour time frame and moving to see what kind of momentum we're getting, we immediately realize that we are still in a bullish momentum. The market is still in a bullish momentum, in a bullish environment basically. This is the first time that the market actually changed its momentum. You can see the EMAs have cut for short exactly here. We are changing to a bearish environment. The EMAs have cut for short. The 10 is below the 20. The MACD, I will now show you. The MACD has just crossed for short, as you can see, and this is the moment in which you're supposed to be looking to short this pair. So let's look at what kind of numbers we have around this area. You immediately realize that the 20 is all the way far up here, and at the moment we are 91. The price is 0.6891. Now immediately you should realize that 91 is just the slippage number for 80, and as you can see 80 already hit. So obviously the region we are in is the 80.95. So we are in the 80.95 region, so we can immediately take short from here. Stop loss, you realize that we have some very strong structure all around here. All of this area, as you can see here, is a structure area. Now, if you take short, you want to make sure that your stop loss is above the structure area. So what you will do is take your stop loss and put it here above, also if possible above some strong Fibonacci levels. So let's take our Fibonacci from the high to the low, and you can see that you have it above the 382, above the 50, and basically above this wicks here, so you should be perfectly fine. If the market will go all the way up here, there is a high probability that the setup will fail, and that is exactly the correct way in which you're supposed to place your stop loss. So let's take our Fibonacci on this leg, because if now the market moves to the downside on the weekly, obviously this will be the previous leg. There's no need to really go to the weekly, but let's go to the weekly just to show you that that is actually the previous leg. This push to the upside, this push to the upside is exactly the previous leg of this push to the downside. So let's go back on the 4 hours. We can just take our, by the way, we don't need the indicators anymore, because obviously we already know that we are now in a bearish environment. And what we can do is just take our Fibonacci from the high to the low and identify our take profit. We know that this is the minus 27 of the weekly leg, so this is the first strong number above, because if the minus 27 is 33, 0.6733, then the first strong number above will be 0.6750. So we can delete our fib, and let's see if we get at least a 1, 2, 3. As you can see, even using a very big stop loss, we still have a 1, 2, 3, and that is exactly what we need. And basically, exactly at this point, you go risk-free, because the market went down, made a little retracement, and continued to the downside. That is the moment in which you need to go risk-free. Why not before? Because the market could have got to retest this area and then continue the push to the downside, and you want to remain inside of this trade. You don't want to go risk-free to just see the market keep melting to the downside. Let's see if our target hits, and as you can see, our target hits. Perfect. Now let's go to our next example of the ICI strategy on the weekly time frame. So the next example will be obviously a head and shoulders pattern. So the market broke structure to the upside, meaning that basically, what does it mean that the market broke structure to the upside? In this particular case, the market did not create a higher high, but we created a head and shoulders, because obviously if the market goes down, up, down, up, at this point you're expecting the market to continue the push to the downside. But if the market from here pushes above and creates an equal high, at this point structure is broken, because you're expecting a head and shoulders, because obviously this was the structure area and the market broke it to the upside. So at that point structure is broken, and again is a confirmed shift in the trend. So again, let's use the replay tool. We know that we have our 382 down here, so if the market will go to reach it, we will basically be able to take this trade and look for a valid entry. So let's take our Fibonacci on the weekly time frame. Now if you remember, the weekly leg will obviously be from this low to this high. We can take it also on the 4-hour time frame, because we already know that the weekly leg will be from this low to this high. And you can see that the 382 hit just now. So you already know that the 382 hit, perfect. You don't need the Fibonacci anymore. You don't need this anymore. What you need to do now is look at what kind of environment you're in. And as you can see, you're still in a bearish environment, so we cannot take this trade. Still in a bearish environment. Now this is the first time that the market shifts its momentum to the upside. It's pretty clear that the MACD is now above the zero. EMAs have just crossed for long. Let's look where is the structure. Now it's clear that you have the structure around here and here. So basically all of this area is structure area. We have strong support around here. So if the market does make it to pull back here, this will be a very good opportunity to go long. So what you're supposed to do is look what kind of numbers you have. You have 45. Now 45 is obviously 50. and you have 37, and 37 is obviously 35, which is a slippage number of 50. So at this point, what you can do is take the long from here, since you have structure also in this area, put your stop loss protected by structure all the way below here, and look at what kind of target you have. Now the weekly previous leg will be this push to the downside. If you go on the weekly, it's immediate to realize it. And you just take your Fibonacci, and your take profit will be the first strong number below the minus 27. So if this minus 27 is 57, it's basically 0.7057, your take profit will be 50, because it's the first strong number below. So this will be your trade, and you immediately realize that you don't really have a 1 to 3. So what you can do is, just instead of putting your stop loss below the low, you can just take your Fibonacci here and put your stop loss below this 78.6. So basically below the last possible Fibonacci level, because you know that 78.6 is the last possible retracement before the market creates an equal low. And then when the market creates an equal low, it means that we're expecting a shift in momentum. So again, your stop loss will be perfectly fine. So let's see if we get failed on this order. Perfect, we just got failed on the order. The market, we could have entered all the way down here. The market actually went for a retest of the previous resistance, not for support. So our entry was a little bit early. However, we did have some support here, so it was better to take it from here. Yes, a little bit early entry, but overall it seems on point. That this is exactly the moment in which you go risk-free, because the market goes up, down, starts the next impulse, and you go risk-free on the trade. And market hits our take profit. Perfect. So I already know that the concept is basically clear, but I want to go on a few more examples. So again, here we have another example of the impulse correction strategy in place. The market goes down, up, down. So this is the low, this is the high. Then what you realize, that the market makes this impulse to the upside, creates a high that is higher than this high. So the market created a higher high. So at this point, what you're supposed to do is, let's use the real replay. At this point, what you're supposed to do is just take your Fibonacci from this low to this high and wait for the market to retrace at least to the 382. And you can see that the market just did retrace to the 382. So at this point, what you can do, go to the 4 hours and look for an entry. So what you're supposed to do, you already know it. Look for a shift in momentum. So the market is still bearish. Let's wait for a shift in momentum to the upside. Everything is still bearish. This is the first time the market shifts momentum to the upside. As you can see, Magriba above the zero, EMA is cut for long. Perfect. We don't need indicators anymore. We can go back to price action and understand where our entry is. Now, you can see that we have support all around this area, because the market, this is the previous resistance or support. The market was rejecting this area, and now this area is support. So what you can do is look what kind of prices you get, and you realize that you have 0.6878. 78, in other words, is 80, and the slippage of 80 is 65. And as you can see, that is exactly the area of price that you get. So at this point, what you're supposed to do, you can take your entry exactly from the 80, since you are getting rejection around this area. However, if you do this, basically you will have a really huge stop loss, because your stop loss needs to be at least below the 78.6. So let's see if you get a 1 2 3. If you get a 1 2 3 by taking your entry in this way, then anyway, this is good because we know that we will be most likely filled. We know that our stop loss will be fine, and if it gets hit, we have a high probability that the setup has failed, and our take profit, we have it up here. But as you can see, we're not getting a 1 to 3, we're getting a 1 to 2.79, so not really a 1 to 3, and we can't decrease really our stop loss. So what we need to do is basically, we know that our target is here, and what we need to do is decrease our entry price because we cannot afford to take such a high entry. We need to take a lower entry. Now, how you're supposed to pinpoint your entries? Simply taking your Fibonacci's on this impulse. We were taking it for the 382. If we take it from the 50, the stop loss will be exactly the same. Take profit will be exactly the same, just the entry is a little bit lower. I know we have the risk that the market will not hit our entry, it will just hit here and then continue to the upside, but we cannot take it in that way because we don't have a 1 to 3. In this case, we have a 1 to 3.8. So let's see if the market will fail us. As you can see, the market does fail our order. So basically it goes to test the 50%, exactly the 50% where our order is. So at this point, let's see what's going on. We still can't go risk-free. We still can't go risk-free. Okay, now we can go risk-free because if you look closely, what happened is that the market created this impulse to the upside, then it went for a retracement all the way to here, and then again it went to the upside. So at this point, we can go risk-free on this trade. So basically our stop loss is 1 pip in profit. Our stop loss is here. And again, our stop loss gets hit. So in this particular case, we are out risk-free on the trade. Now there are two things you can, I'm happy that this happened because I want to explain something. There are two things that you can do in this particular situation. One of the things that you can do is bring back your indicators and understand if something changed. Are we still in a bullish environment? The answer is yes, we are in still bullish environment. Let's go back. Do we still have strong support? Yes, we still have strong support. We have our valid entry. Because if you look left, this is the previous resistance, this red candle that is now turned support. Perfect. Then you're supposed to ask yourself, do we still have our strong numbers? The answer is yes. Here is our strong number. We have 80 and 65. Perfect. So what you're supposed to do is take another trade because nothing changed in the market. Everything is still overall bullish. So if you will be stopped out from this trade, you will be perfectly happy. But again, you realize that you cannot take this trade from here because overall you don't have a 1 to 3. So what you're supposed to do is, if you take your Fibonacci from the low to the high, you realize that this is the 78.6. So if you take your basically stop loss few pips below the 78.6, you still have a 1 to 3 risk to reward. Let's see if the market will just break, because in this particular case, when you re-enter a trade, is always with higher risk. Why do I say with higher risk? Because if the market will now go to the downside, it will create an information, and at that point it could take you out and then start a next impulse to the upside. But as you guys know, trading is a game of probabilities, so you never know what is the best probabilities, but you can stack up as many odds you can in your favor for your trades. Use at least 1 to 3 risk to reward, and you only need to be right 3 times out of 10 to be in profit. So it seems the entry is actually working. So this is the situation. The market is basically continuing consolidating in this particular way. And in this kind of situation, since my entry is below this trend line, and if the market breaks this trend line, overall where market structure is broken, what you can do in this particular situation is go risk free. So let's put our stop loss 1 pip in profit, because at this point our stop loss is protected by entry. But that is the point. Every time your stop loss is protected by structure, you can go risk-free. That is the rule. Every time you have a stop loss that is protected by structure, then you can go risk-free. That is why most of the times we go risk-free after we have basically a pullback and another continuation, because at that point our stop loss is protected by structure. So our stop loss was hit again, so we have two break-evens on this trade, and basically the market closed below this trend line. So if now the market will show us that this was a fake breakout and go to the upside, we will not be inside of this trade. So as you can see, the market just took us out break even and then went to our take profit. And sometimes if the market starts going crazy in this way, it's okay, it's perfectly fine. You will find another opportunity, you will find another setup. You're at break even, you didn't make money, but you didn't lose money, and in the end it's all about protecting capital. So we have 3 wins and 1 break even. So we made a lot of percentage with just 4 trades. So let's go with the last example, then I'm sure that the concept is more than clear. We have the impulse to the downside from this high to this low. The market makes a retracement, and this retracement is at least to the 382. Very simple. You can clearly see it. So what you're supposed to do is now go on the 4-hour time frame and see by using your template of indicators to see if the market is in a bullish or bearish environment. So you can clearly see that the market is still in a bullish at the moment, so you cannot short. You can see that this is the first time that the market kind of shifts its momentum to the downside. You can see that we have a break below the 0. We can see that the EMA is crossed for short. Now overall, this will be a little bit of a higher risk entry because you clearly have a head and shoulders. So you can take the entry, but it will be a little bit more risky. You realize that you have your strong numbers here, 20, 35, and we can put our stop loss above the high. Our take profit, you already know it. You take your Fibonacci on the weekly retracement. Here on the 4 hours, there is no need to go back on the weekly to take it because you already know it's the highest point and the lowest point of this push basically, and your take profit will be the first strong number above this level, which in this particular case will be 80. Since here we have 0.6753, it will be 80. So as you can see, head and shoulders actually did hold the price. We already said that this was a higher risk entry, but actually I was sure we would get stopped out, but we didn't get stopped out. That is why it's important to always protect your stop loss with structure if you can. It seems the market will keep pushing to the downside, but at the moment we are still above structure, so we could easily go back and take us out. As you can see, perfect. So we are out of the trade. So we had three wins for more than 1 to 3. So we are way in profit, and we have 1 break even and 1 loss, and that is perfectly fine. We made it. We are way up in profit, and we are having more than 50% win rate. That is more than enough than what we need. Let's see if we will get another entry. So as you can see, the market shifted to the downside. Now, there is one thing you need to know about these candles. You know that this candle, basically the next candles, when you see a candle like this, the next candles are supposed to fill in the wick. I already explained this in other sessions. If you see a candle that looks in this way for a red candle, or in this case for a green candle, and basically has a wick that is more than 50% of the body, then expect the next candle to fill in the wick and continue the push to the downside. So this is a valid entry for any strategy. This is one of our valid entries for any strategy. We already spoke about this. So again, you have your numbers 20, 35. You know the market is below them. You can take your short. If you look at price action, you don't need indicators anymore. You know that the market has has basically shifted in a bearish environment. Let's delete this to keep charts clean. Perfect. You know that your take profit will be at 80. We already saw this before. With 1.6780 will be our take profit. And if you look at structure, you see that we have a high here, so our stop loss will be above the high. And overall, you have a 123.88. Now, if you remember, we lost 1 R here. In other words, if we risk 1%, we lost 1% here. And here, we're risking 1% to make 3.88. So if this trade will be successful with one trade, you recovered the loss, plus you made an extra 2.88 of your normal risk per trade. So that is the importance of risk to reward. So that is exactly the moment in which you go risk free. This candle went all the way up and then rejected all the way down. So basically you can put your stop loss break even now. And the market, let's see if it hits our take profit. Perfect. Our take profit was hit on point, and we recovered the loss plus made profit. So we had 4 winning trades, 1 break even, and 1 loss. So we are way up in profit, and this is exactly how you're supposed to apply the ICI strategy to the weekly time frame. So in exactly the same way, but you will make a lot more pips and a lot more percentage.